there may be tariffs on imported gold and silver, which there's never been before. And, that would be a great calamity. Particularly, imagine if you put on this trade, and again, you're not making huge amounts of money. I mean, 4% per annum on, $3,000 is, what is that? 10% would be $300, $30, $120 for a year. So, $10 for a month, $20 for a 2-month trade, something like that per ounce. Not a huge amount of money. And all of a sudden, there's the possibility of a 25% tariff.
The possibility of tariffs on imported gold and silver, which has never happened before, could be disastrous. Traders typically earn small profits of around 4% per year on gold priced at $3,000 per ounce. However, a 25% tariff would mean a $750 per ounce loss, drastically impacting the market. On March 25, 2025, gold prices increased, with spot gold rising by 0.1% to $3,015.66 per ounce, driven by ongoing concerns about upcoming tariffs and their potential economic impact. Keith Weiner, a prominent economist, points out that gold prices are rising due to intense physical demand, rather than speculation in the futures market as buyers seek protection from economic uncertainty and credit risks. Unlike the 2009 to 2011 period, when gold was bought out of inflation fears, today's demand is driven by concerns over monetary instability and government policies. Silver, however, is lagging behind gold, as industrial demand is weaker and wage earners, who typically stack silver, are under financial strain. Additionally, tariffs on goods containing silver may further impact its price. Meanwhile, assets like classic cars are seeing declining demand as younger generations lack the same nostalgia for them. Check out the full video for more insights. If you found it valuable, don't forget to like and subscribe to stay updated with the latest content. Now let's redirect our attention towards the interview.
How the basis is moving with the price. So if you see rising price accompanied by rising basis, which means the futures contracts are getting more expensive relative to spot, that spread is widening. That means the buying is occurring largely in the futures market. That is the pattern we saw from, after August of 2011, when the gold price had its peak the last time around, just under $2,000, through 2018. Because every time the price would go up, you'd see the basis rising. Not a durable move. This is people in the futures market front running only themselves. The price will come back down. We had articles looking at the half-life of, how long would the move take before it reversed, which means it's all been driven by buying in metal versus buying futures, which is a very important distinction. People who buy metal are much more likely to be holding that for years or decades. People who buy futures generally do so on very great leverage. You can do that on 20-to-1 leverage. And if you're buying something even on 10-to-1 leverage, you have to sell it fairly quickly. That leverage has a cost, number one. You're not going to hold that position for too long. Number two, if the price goes up, you take profits. That was the whole point. If the price goes down, you have to cut losses. You have to stop. So either way, people jump into the futures market to speculate, jump out fairly quickly. People who buy coins, take them home and stick them wherever, in a safe, under the floorboards, whatever. And generally, those aren't coming back to market for a long time. So that is a durable, bit of demand. And the demand that we've seen has been of that sort, where you see the basis stubbornly refusing to rise. Nothing dramatic. I don't see permanent gold backwardation or any of those scenarios happening. There's a reason why everybody's buying gold. And it's not because they're betting on its price. Not yet. When that happens, you'll see the gold basis rising. It's because people are concerned about credit risk. And sure, the dollar may go up relative to the other currencies, because everybody's defaulting. But do you really want to be a creditor in a world where everybody's defaulting? Sure, the surviving credits go up in value, but there's a risk that maybe your credit isn't one of the ones that makes it. And so, there's a monetary madness going on. Everyone expects that's going to get worse, right? So look at COVID, enormously destructive economic policies. We locked down the whole economy. And that was, you started to see the stock market collapse. But then how did they fix it? Massive stimulatory, both monetary policy and fiscal policy. It was like Oprah Winfrey, and you get a free $10,000 check, and you get $10,000. You get, everybody getting free money all over the place. That's how we made the stock market go up and continue the boom. Well, I think with good reason, people are expecting that, to compensate for tariffs and other destructive policies, that, there will be another fiscal, stimulatory effort, as well as getting back to the Fed, a monetary stimulative effect. Well, it's a good thing to be owning gold when they're going mad like that. Gold is the thing you want to own, not necessarily stocks where, okay, they're stimulating, but, sales volumes are falling, revenues are harder and harder to get, margins are getting crushed. Gold is the thing to own. And so I think that's obvious globally. Everyone's buying gold for this. And this time I'd say for better reasons. In 2009 to 2011, everybody bought gold after fear consumer prices were going to rise as a consequence of QE. And consumer prices didn't really rise as a consequence. Commodity prices rose in a speculative wave and then fell. I don't want to give away what we said in the report because we do make some price targets, but I think substantially higher prices, coming ahead. All the fundamental drivers are in place for it. And as more people discover it, more people get on board, it becomes right after that, on Friday, we made over $3,000 in the morning. I haven't looked at the price today, but I think it's right just about there. It wouldn't surprise me if we decisively break through 3,000 this week. Wouldn't surprise me if we had a correction. People love psychological lines in the sand. 3,000 is an even number. I mean, it doesn't mean anything to the gold market, but it's a psychologically even number. Could there be a correction now? Could it be next month? Yes. But longer term, the trend is up. Silver massively outperformed gold, and we ended up with a gold silver ratio of 30 versus, 90 or whatever it is right now. The drivers for silver just aren't as strong. The fundamental demand for silver isn't as strong. And I think the reason is silver, partly there's the industrial uses of it. And obviously the millennials, very little experience with those cars. I don't think the demand, the demand is there. So people that are selling assets.
Overall, the current surge in gold prices reflects deeper economic concerns rather than mere speculation, while silver struggles due to weaker industrial demand and financial pressures on wage earners. Potential tariffs on precious metals could further disrupt the market, adding uncertainty to an already volatile environment. Investors should carefully assess these factors when considering their positions. How might government policies influence future gold and silver prices? What impact could rising tariffs have on the broader economy beyond precious metals? That's it for today. Share your thoughts on Keith's analysis of gold revaluation in the comment section below. If you find this video informative, don't forget to support your finance log team and turn on notifications to stay informed about our latest videos.